I want to share with you guys something that I feel is very important and not a lot of people talk about. So, this is how you can understand that price is not going to pull back to a premium or a discount. And that all has to do with if price is starting to spool higher prices. And what I mean by that is price starts to relieve real displacement with fair value gaps. And if you see bearish PD rays from the sell side of the curve start acting as support on the buy side of the curve, that is a good indication that price is going to leave breakaway gaps. And what I mean by that is this example today. So price had this 15-minute liquidity down here on NQ that was taken, and we left this one down here. Why did we leave this one? Well, if you look at ES, you can see that ES equal lows or relative equal lows here both got taken. And after that, this was the last low before this low that needed to get taken before a smart money reversal could occur. So if ES would have came down here and taken out this low, price would have then flipped from a buy program to a sell program because this low should be protected. All price was doing was coming down into a severe discount before repricing higher. And so back to what I was talking to you about was you can see that this is the sell side level that triggered this reversal from today. If you go to the 1 minute time frame, you can see that price was starting to displace inversed PD raise, right? Acting as support here after we close over, acting as support. You can see the bodies tell the story. And then price continues to close over bearish PD raise. What do we leave in here? Two fair value gaps. So now what a lot of new ICT traders and even myself do sometimes. You look at the fractal dealing range. You can either use this low or this low, right? So at the time, in hindsight, this is what you're looking at. So we're going to remove this. This is your swing low at the time. So you go like this, you put your 50% level, you're like, oh, perfect. Here's a fair value gap underneath the 50% level. But price never comes down there. Why? Okay, so well, what did we do? We inversed this bearish PD array, right? Bearish fair value gap. Big strong candle close above, right? And more importantly, if you continue to wait, right here is where you get the breaker. You get a sweep. That can be your market structure shift if you were waiting for something, even though you already got multiple down here. But say you're new and you're waiting for this, that could be your change in the state of delivery or market structure shift, however you want to look at it, and you leave behind a breaker. So you mark that out. Now you can see that price dips into this fair value gap, leaving this swing low, right? Tapping the 50% of the inversion. If you mark out this, you can see price is respecting this fair value gap as well and doesn't even come into the consummate encroachment or 50% of the fair value gap. That's a very bullish sign. When you start to see price expand, you really don't even want to see price come back into the 50% area of an order block or a fair value gap. So, as you continue higher, what do you have? You have an inversion fair value gap paired with a breaker after a market structure shift. That is why this fair value gap can get left open. And lo and behold, what happens? We're off to the races, right? So, that this is a good example for exactly why you don't need price to pull back into a premium or a discount before going higher. And that's just one example. This happened again earlier today. So you can see price sweeps an area of liquidity paired with the fair value gap. This is an untapped fair value gap. So you can anticipate some kind of run into internal sell side, right? Doesn't have to be sell stops because we know that internal sell side rests inside of fair value gaps. So you have a fair value gap and a breaker right here. These two consecutive down close or up close candles are a breaker paired with this order block, right? So a lot of confluence. And you can see price is respecting every single one of these bullish PD rays. So there's no reason for you to be shorting this, right? So say you're too scared to long down here because price is rejecting this 1 minute. So what happens? You wait for price to continue higher. Where's our draw? Our draw is higher. What do we know about price? Price likes to draw to the midnight open, and what do we have? A bunch of clustered buy stops. When you see liquidity like this is called low resistance liquidity. Price likes to draw to this kind of liquidity. So if I was looking at this and looking for a trade, this would be low hanging fruit. This is the highest high in all of these clustered highs paired with the midnight open. And you don't have to target all the way up here. You could target here, here, or here. Either one, they all work. So, getting back to this, say you missed that entry, what do we have? You continue to look to the left of the curve. The sell side of the curve should be acting as support when you enter the buy side of the curve. So, what does price do once you close over this 1 minute fair value gap? You can be buying here. What do you have underneath? A bullish fair value gap. And what's this? It's a bullish breaker as well. So you have another unicorn setup, and this is even more confirmation since price is displacing after delivering into internal sell side. So even if you missed that one, right? What do we have? Even though this is lunch hour, what do we have? So we still have our draw on liquidity, and price continues to go higher, and then what happens? So that was our lowest hanging fruit, and look at this right here. Look how clean that is. This is engineered liquidity. This is perfect. This is what you want to see on the sell side of the curve when you're moving to the buy side of the curve. This is the kind of liquidity you want to be targeting, especially if it pairs with the midnight or 8:30, either or. Low hanging fruit target objective. Sell side relative equal highs. That's what you want to be targeting. So, what happens when we take out this liquidity? Price displaces over it, candle close over it, leaving a fair value gap. You can expect price to make this. You can expect price to be supported by this fair value gap, and what do you have is extra confluence. This inversion fair value gap. You can wait for this to get inverted like this. There's your inversion fair value gap. Even if you don't want to be buying here, you could now be buying any retest. Right there is your entry, and look what happens. Where's your next target? Here, 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 any of these highs. And if you go like this, we use our cheeky standard deviation tool. You can either use this high, this high, this high. It all depends. It will change depending on where your liquidity lines up, but look how beautiful this is. 2.5 standard deviation, 2 lines up with this, 2.5 lines up with this, and if you take an even bigger extension, look what happens. 2 standard deviation lines up with this. That's what you want to be seeing, and look what happens to price. Run on sell side, right? Return to sell side liquidity. Return to midnight. Smart money likes to be buying below 8:30 and midnight. Where's your draw? Relative equal highs with the 2 standard deviation. What happens to price? One more run on sell side. And where do we stop for the day? Right at the 2 standard deviation. So this is just a short little video for you guys. I hope you guys enjoyed this. I'll be making more content for you guys. Let me know if you want any specific content down below, and I'll see you in the next one.